Hello everyone, this is Harish Thakkar. I have over 25 years of experience in financial markets. You've heard a lot about something called as common stock. This is the bread and butter of equity investing. When you buy common stock in a company, you're not just purchasing a piece of paper, you're actually buying a piece of ownership. As a shareholder, you have a voice, often in voting on critical issues like choosing the board of directors and so on. You know, over 80% of the stocks traded on the major exchanges like the New York Stock Exchange or NASDAQ are actually common stocks. Now let's move on to something a bit more exclusive, preferred stock. Think of this as the VIP section of equity markets. Preferred stockholders get priority when it comes to receiving dividends. In fact, they often receive a fixed dividend, which makes it an attractive option for investors looking for a steady income. Coca-Cola, for instance, has issued preferred shares and investors enjoy predictable payouts. But unlike common shareholders, preferred shareholders are more like silent VIPs. They usually don't get voting rights, and while they are ahead in line to receive assets in the event of a company's bankruptcy, they might miss out on some of the growth opportunities that common shareholders enjoy through capital appreciation, which again is a very big feature as far as common stock is concerned. Now let's talk about something a bit more global, the ADRs and GDRs. The American Depository Receipts and the Global Depository Receipts. These are exciting because they let you invest in foreign companies from the comfort of your home country. ADRs are certificates that represent shares in a foreign company but are traded on the US exchanges. For example, you can buy shares in Alibaba, a Chinese company, on the New York Stock Exchange thanks to ADRs. Similarly, GDRs or Global Depository Receipts allow for trading foreign stocks across global exchanges. These mechanisms make it easier for investors to tap into global markets without dealing with the complexities of foreign exchanges and currencies. To sum it up, whether you are eyeing the potential high returns of common stocks, the steady income of preferred shares, or global investment through ADRs and GDRs, the equity markets offer a world of opportunities for young investors like you to explore. Here are some of the examples of equities, preference shares and ADR, GDRs. Equities, of course, you know, there's so many stocks listed on the stock exchange, be it Infosys, Reliance, TCS, State Bank, and many more. Look at examples of preference shares, and here it's important because when you read something like EIH Limited 9.6% preference shares, what it basically means is that EIH company has issued preference shares with a fixed dividend of 9.6%. That's what it means. And if you look at the other example, which is JWS Steel Limited, 8% preference, non-cumulative, non-convertible, non-redeemable. Now these are some of the types of preference shares which we will be explaining and understanding as we go along. So hold on for that. Here are some of the examples of ADRs and GDRs. So some of the popular companies like Infosys, ICICI Bank, Dr. Reddy's and HDFC Bank have listed ADRs on the US exchanges. These are some of the closing prices. These are in US dollars. Let's look at some of the features of equity. The single most and the most important one is capital appreciation. People invest in equities for capital appreciation. They want their money to grow from 100 to 120, 140. We've already talked about it. Equities, the income as such, the dividend income is discretionary. So why would somebody want to invest in an equity where the income as such or the return is discretionary? Unless there is an inherent increase in the price, which is capital appreciation. So equities give capital appreciation, and this is one of the strongest and the biggest draw for anyone to invest in equities. If you had invested 1 lakh in HDFC Bank in 2000, it would be 8 crores today. That's the kind of potential capital appreciation an equities can give. But of course, there is risk to it. The common adage goes, wherever there is reward, there is risk. So risk and volatility is another feature of equities. If the company does not do well, if the company's performance is not good, runs into losses, the prices can go down, which means there is loss as well. In fact, in case if the company goes bankrupt, the stock price can even go to maybe 1 or 0, God knows, whatever it could be. You can take examples where companies have gone bankrupt like Satyam Computers, or there have been issues with some of the functioning of banks like Yes Bank, and the stock prices have gone down from 900 to even 5 rupees. So these are some of the examples. As far as equities is concerned, at the time of liquidation, the equities will get the money back, but only if something is left after paying the others, like the bondholders or the creditors or even the preferred shareholders. The other features of equities include information access. Once a company is listed on the exchange, it's a mandatory requirement for the companies to notify the exchanges and the public in terms of their performance or any major event or news that can potentially impact the stock price. Be it the quarterly results or the annual results, they're supposed to disclose this information and make it public for people to act on it. The other feature is subsequent offerings by the company to raise capital, and one of the popular ones is the rights or the stock splits. When a company decides to raise additional capital to its existing shareholders, it's a rights issue. As the word itself is explaining, rights. The existing shareholder have a right to the first, to the upcoming issue. Then there is the stock split. If the face value of the stock is, let's say, 10, and the company decides to split it and make it 5 rupees or 2 rupees or 1 rupee, then that's a stock split. What it essentially will do is increase liquidity in the market. So if you had 100 shares of face value 10, if the company splits it to 1 rupee, then you will have 1000 shares. So the value remains same, the number of shares increases, the stock prices decreases, but since the number of shares increase, it gives the liquidity. So equity investment is basically known and advised for long-term investment potential. Historically, the markets have given better than results than any other investment avenues, the popular ones. Markets have known to be giving great results and investment returns since the time the indices came into play. For example, in 1979, the Sensex was 100. Today, it's 84,000. Let's talk about the advantages and disadvantages of equities. We've actually covered a little bit of advantage while I was talking about some of the features, but might just be a good idea to quickly repeat those. So as we had spoken, the potential for high returns is one of the big advantages of equities. Equities have shown the potential of higher longer term returns compared to other asset classes like bonds or gold and so on. The other one, which is the capital appreciation part, equities as such, the income is discretionary, which I had mentioned earlier. The change in the stock price, the increase in the stock price, the capital appreciation is why people want to invest in equities. And of course, the dividend income, which is based on the company's performance, though discretionary, but can give yields up to 5 to 7%. The other advantage of equities is the high liquidity. Equities are listed on stock exchange, and which means that you can sell equities whenever you want, and the money gets credited to your account within 2 or 3 days, and in some cases even the next day. Equities also have the advantage of diversification in the sense that you can put your money in different sectors. Let's say the pharma sector or IT sector or FMCG or oil and gas, defense, public sector undertakings. So when you're investing and you invest in different sectors, you're diversifying your investments and able to get good returns across different sectors depending on the performance of those sectors. As I had mentioned at the start, equities denote ownership. When you invest in equities, you actually own a part of the company to the extent of the shares that you own. So companies give you voting rights. You have a say in the company's management on some of the critical issues that come up during the annual general meetings or special general meetings. Transparency. As I had mentioned, companies are required to disclose information. All publicly listed companies are required to give information about their financial performances and even any other performance or any other news for that matter which can impact the stock price. Let's talk about some of the disadvantages. Volatility. Stock prices can move like crazy. One day they are up, the other day they are down, so which means that there is a potential loss to it as well. The short-term fluctuations in the markets can lead to an erosion in the value of your investments. This volatility can be unsettling for some of the investors, and hence there is a risk of loss as well. So equities potentially can erode your investments, unlike some of the other investments like bonds where there is not much of a volatility and hence the risk of loss is less. Equities are more riskier. Since dividend income is discretionary, there is no guaranteed income as such. So one is not really assured of an income when you invest in equities. There is also no control in the sense that shareholders do have voting rights, but as individual investors or retail investors for that matter, you don't really have any say in the management, and thereby there is a very limited influence on the company decisions. Equity investment is about long term. As I had mentioned, there can be short-term fluctuations and can lead to losses, but the equities have to be kept for a longer term, which means there has to be a longer term commitment as far as the investment goes. So in short term, the equities may not perform, may not give you as much returns, and hence there has to be a commitment for a longer term as far as equity investing is concerned. Investing in equities also requires research. There are so many companies listed. There are approximately about 9,000 companies listed on the exchanges, the major exchanges of course in India. How do you invest? Which company to invest? Which is the right company to invest? Even if you were to decide to invest, let's say in pharma sector, there are so many companies within pharma sectors. So how do you really decide which company to put your money into? This means that you have to research, you have to understand their financial statements. You have to learn what they are doing, how are they doing, and keep monitoring it. And finally, as I had mentioned, equities do not have a regular income. There is no guarantee and there is no regularity of income. A company may give a dividend in one year and choose not to give dividend the other year. And finally, in some of the equities, while equities are known for liquidity, but not all stocks are easily traded. Not all stocks are liquid. Some of the illiquid stocks can pose a liquidity risk, which means essentially that you have a stock, but since it's not traded on a daily basis, it's not easily traded, you are not able to sell it. So this is one of the risks that some of the equities, illiquid equities, pose. And finally, of course, the individual stock has its own risk in terms of the volatility, in terms of the performance, in terms of the dependency, in terms of the company's performance and the overall market performance. The income, be it dividends or capital appreciation, is of course subject to taxation rules. So tax implications also provide one of the disadvantages as far as equity investment is concerned. Let's begin with preference shares. So what are really preference shares? Now, preference shares are a type of equity ownership where the company comes up with certain preferential rights for the common shares. The preference, as the word suggests, is in terms of the dividend and in terms of payment at the time of liquidation. Now let me explain this. It is an equity ownership, but the type of shares are slightly different from the common shares in the sense that there is a fixed dividend that is attached to these preference shares. And this dividend is paid over as a priority over the common shareholders. Why do companies issue preference shares? One of the other features of preference share might explain this better. One of the features is less or no voting rights. When the company wants to raise capital as an equity, yet not give away the control aspect or the voting rights, then this is a good way to issue preference shares. Preference shares also have a fixed dividend, which means that the company is aware of the outgo or the dividend outgo, the cash flows that the company is supposed to pay. Let's look at the features of preference shares. The first one, as I had mentioned, is dividend priority. Preferred shares typically have a higher claim on the company's profit in comparison, and this is relatively speaking, in comparison to the common shareholders. So if and when the company decides to declare dividend, the first preference will be given to the preference shareholders and then the common shareholders. Moreover, the preference shares have a fixed dividend. The rate is already decided. Now this may be a plus as well as a minus point, because the positive here is that there is a fixed dividend irrespective of the company's performance. If the company decides to declare dividend, then there is a fixed percentage that the company is supposed to pay to the preference shareholders. It is determined as a percentage on the face value of the shares. So in the previous session we had explained EIH or East India Hotels or JSW Steel came up with 9% preference shares, 9% on the face value of the shares. So that's the fixed dividend that the shareholders get at the end of the year or whenever the company decides to declare dividend. And finally, the limited or no voting rights. The preference shares normally do not hold any voting rights. The preference shareholders do not get any voting rights, or in some cases there may be limited voting rights. And finally, the word preference again explains this better. There is a preference or there is a priority at the time of liquidation. When the company is undergoing a liquidation, the question comes, who gets paid first? In what order? Of course, at the top of the list are the creditors, the bondholders, and in that priority. But relatively speaking, the preference shareholders get a priority over the common shareholders. So here's the example, here's the feature in terms of priority of liquidation. So if, let's say, there is a company, ABC Industries, and I don't want to name any real company here, but if there is a company and it undergoes liquidation, and then there are certain assets left post paying the bondholders or the creditors, and there's something left for the equity owners or the stockholders, then the first preference goes to the preference shareholders, and if there is anything remaining, anything residual, then that goes to the common shareholders. The company may issue different series, every year there could be a new issue or can come up with different series and different types of preference shares. And as we go along, when we look at the types of preference shares, we'll discuss this in more detail. Now let's look at some of the types of preference shares. And there's quite a lot of variety. Let's start off with cumulative preference shares. The best part or the beauty here is that the type or the word itself explains in terms of the feature it brings along. Let's start off with cumulative preference shares. So these are shares, the preference shares, where the unpaid dividends are accumulated. So let's take an example to simplify this. Let's say there is a preference share that holds 9% dividend, but for reasons like company's performance or the company chooses not to declare dividends in that particular year, or is unable to for financial reasons or whatever, the 9% that is supposed to be paid to the preference shareholders will have to be paid the next year or the subsequent years. So the dividend is getting accumulated. So the preference shareholder here has somewhat an advantage over a common stockholder. The common stockholder will lose the year without any dividend, will not get paid any dividend just because the company did not do well. But the preference shareholder, though, is not getting paid in that year, but the dividend is getting accumulated and will be paid in the subsequent years. Now this is only if the preference shares are cumulative preference shares. So there has to be this feature attached to it when the company has issued these preference shares. And non-cumulative preference share, of course, means that there is no such provision, or the unpaid dividends are not really carried over the subsequent years. Then we come to convertible preference shares. Again, as the word suggests, these are convertible. in the sense that the preference shares after a fixed number of years or at a fixed date get automatically converted into common shares. This allows the investors to benefit from a potential capital appreciation. This is again a feature. So this is like trying to get the best of both the worlds. So for some years, initial years, there is a fixed dividend, there is a fixed dividend that's coming for some years, and after some years, these preference shares get converted to common shares, and that allows the investor to reap the benefits of capital appreciation after that particular point. Non-convertible preference shares again means that this feature is not available with such preference shares. Participating preference shares. The participating preference shares, now if you look at the definition of preference shares, they get a fixed dividend irrespective of the company's performance. So if the company is done exceedingly well, the preference shareholders still get the same percentage that was pre-decided. However, in case of participating preference shares, and the preference shares should have that feature inbuilt, this allows the shareholders to receive additional dividends at times and in those years where the company does exceedingly well. In other words, the preference shareholders participate in the surplus, in the additional profits, in the additional good performance year over and above what they are supposed to get as a fixed preference. Now, non-participating preference share obviously is a situation where the preference shares do not participate in any exceptional performance and get the fixed dividend that they are supposed to get, as has been mentioned in the document. Coming to redeemable preference shares, now company may issue redeemable preference shares, which means that they have the option to buy these shares from the shareholders after a specified period. So call it a buyback of the preference shares. This feature allows or gives the option to the company to buy the preference shares back from the redeemable preference shareholders after a specified date. And irredeemable preference shares obviously means that there is no such feature available with the company. And finally, we are looking at adjustable or floating rate preference shares. Now, in terms of financial securities, some securities have certain features, the other securities have certain other features, and the markets or companies or issuers for that matter make efforts to try to give best of both the worlds. Now, for example, and to substantiate this point, if I have a preference share which, let's say, gives me 7% dividend, and I have been holding these preference shares, and let's say the market interest rates are at 9%. Now obviously these 7% are no longer really attractive because they're giving me 2% less than what the market is giving. Why would I want to invest in a 7% security when the market is offering me 9%? So here's where the issuers kind of make it attractive by adding a feature which is called as the floating rate preference shares, which means that the 7% will not remain fixed for years, and it can be adjusted or will be adjusted alongside the market interest rate. Hence the word floating rate. It's not fixed, it's floating rate. And finally, the callable preference shares. The callable, and again the word itself explains, and this also is to do with certain terms like call and put, but this is not the call and put that we generally refer in the derivatives market. Here, call essentially means that the issuer is the company, the borrower is actually repurchasing the preference shares from the preference shareholders before a specified period and at a predetermined price. So when the company issues these preference shares, there is a call option, there is a callable clause attached to it, which says that the company will have the option to repurchase these preference shares from the preference shareholders at a predetermined price, and this is important, at a predetermined price. This gives the company the flexibility to manage their capital structure. Now let's look at the advantages and disadvantages of preferred shares or preference shares, and this may act as sort of a summarization of our discussion so far as well, because some of the features are basically advantages of preference shares, and hence you would see some sort of a repetition happening. Let's get started. Fixed dividend, of course. Preference shares, by virtue of the preference in dividend payment, have a fixed dividend amount or a percentage. So preferred shareholders typically receive a fixed dividend payment, which is an advantage because there is a predictable income stream for them. You know what the cash flows are going to be, you know what you are going to make from the investment if you are buying preference shares. The second, of course, is the priority in dividend payments. When it comes to dividend payments, whenever the companies declare dividend, the preference shareholders get a priority. The preference shareholders are given a priority over the common shareholders or common stockholders. In terms of dividend payment, of course, it's discretionary. In certain times, the company may find it difficult to pay dividends, and if that happens, the preference shareholders will get paid in the subsequent years. So that's again an advantage as such over the common shareholders. Preference shareholders, and by virtue of the word preference, as I had mentioned earlier, there is a priority at the time of liquidation. The preference shareholders get a priority in terms of payment over the common shareholders. Now what must be noted here is that the priority is over the common shareholders. In no way we are saying they are going to get paid first, and the first, of course, will be others, the creditors or the bondholders and so on and so on. But here the priority is over the common shareholders. Lower volatility. Preference shareholders, given the nature of trading or the amount of trading that happens on the stock exchanges, offer low volatility. These are not very heavily traded asset classes on the stock exchanges, which means that they are less volatile in comparison to the common shares. In some cases, there is a potential for capital appreciation as well, particularly if the preference shareholders are convertible preference shareholders. So if the preference shares after a certain point get converted to common shares, the preference shareholders can get the benefit of capital appreciation as well, which is again an advantage, because you get fixed dividend as well as the potential capital appreciation that comes along with those preference shares. In some jurisdiction, in some countries, the preference share holders, or the income or the dividend received from preference shares attracts a lower tax rate. Some of the bondholders or other asset class owners get more tax than the preference shareholders. So that again is another advantage as such. And finally, the companies get a flexibility in terms of meeting their financing needs. So the company can choose what type of preference shares based on their medium-term and long-term capital requirements. They can actually adjust and come up with different series of preference shares, thereby adjusting the dividend rates, the redemption options, and other features like callability and so on. This also helps the companies to strengthen their capital structure. The way they want to kind of raise capital without really increasing their debt levels or commitment in terms of payments, and thereby strengthening and improving their balance sheet. Now let's look at the disadvantages of preferred shares or preference shares. We've covered certain features and advantages, and while each of these features can come with a plus as well as a minus or a disadvantage as such, let's talk about the minuses or the disadvantages of investing in preference shares. First and foremost is the limited or no voting rights. The common shareholders, to some extent and in some way, have a say in the major decisions of a company, and this they can exercise by way of voting rights. Preference shareholders, however, do not have that right, and in some cases may be offered certain limited voting rights, but in most cases do not have voting right, which means they don't really have or any influence, or have very less influence in terms of the company's decision, which impacts the shareholders. Another disadvantage, and could be a relatively an advantage or a disadvantage, is the potential return part of it. Equity investing is primarily for capital appreciation. We've already established that, we've already talked about it. Here, the preference shares, given that they are not really traded very heavily, do not have that element of a very high chance of capital appreciation, which means that the potential returns can be lower, comparatively speaking, lower than the common shareholders. And of course, given that there is a fixed percentage attached as far as the dividend income is concerned, means that the sensitivity to the market interest rate will also and can also be a disadvantage, because you might get paid less when there is a potentially higher return available in the market. Of course, if the preference shareholders have that floating rate element or the adjustable floating rate, then of course this is mitigated to a larger extent, but otherwise this could be a disadvantage. Next part is the non-participation in the company growth. Given the fact that preference shareholders get a fixed dividend, does not allow them to participate in high growth that the company may achieve over years. This means that they will miss out on the capital gains which otherwise a common shareholder would get investing in common shares. And then there are of course the call risk, which we spoke about when we spoke about the callable feature of preference shareholders. The companies have the right or the option to redeem the preference shares, which means this is a risk to the preference shareholders that if they are getting a relatively or comparatively better dividend income and the company does well, the company may call back the preference shares, which leads to a potential lesser income for the preference shareholders. And finally, because the preferred shares are not traded as heavily as the common shares, yet they do experience some fluctuation because of the interest rate sensitivity, because the income, the dividend income, the fixed dividend income is getting compared to the market interest rate, which means that if the interest rates are volatile, this will also mean that the preference shares that are traded will be subject to some sort of a volatility. And finally, the element of credit risk. Whenever you have an instrument which involves a fixed income and is dependent on the company's ability to pay that income, there will be an element of non-payment or the credit risk, which means that if the company faces financial difficulties, it just not may be able to pay dividends, which means that the preference shareholders are not getting the due income that they are supposed to get. And finally, again in comparison to the common shares are traded very heavily on the exchanges and not so much the preference shares, which means that the preference shares are not as liquid as the common shares, which means that if you want to exit preference shares, if you've invested in preference shares and you want to get out of it, it may not be as easy as it is as the normal common shares that are traded on the exchanges.
Found this session valuable? Hit the like button, subscribe to our channel, and tell us in the comments below what topic we should dive into next.